This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 55. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management, and of course, Rich Diaz of Acorn Macro Consulting. What's going on, gentlemen? Rich?
I'm in Porto. I'm a traveler. Do you guys remember the show Carmen Sandiego, or Where in the World is Carmen Sandiego, where these kids have to decide where they are on a map and they're getting clues? That's me. I'm bouncing around. I'm in Porto, which is in the north of Portugal. It's an absolutely beautiful town if you've never been here. It straddles the river, the Douro River. Keith, you love red wine. Your wife loves red wine. You guys are familiar with the Douro Valley. So Porto is at the sort of the mouth of the Douro River, which is the sort of the end of the Douro Valley. And we're just having a great time. It's raining a bit, but it's honestly the nicest city in Portugal, much nicer than Lisbon. Don't tell my cousin I said that. And just having a good time. And I took time out from the pub to come and hang out with you guys and chat shit about the euro and the dollar and China. And so that's where I'm at. What about you, Keith?
Rich is half cut. You just there to party or what?
Yeah, just here to party and do the Loonie Hour podcast, the most important part of my week. Of course, I wouldn't dare miss it.
It's funny for Steve and I, it's Thursday, of course, and for Rich it's Saturday already.
Holy smokes.
Yeah.
Keith, what's going on, buddy?
Well, I'm struggling actually to tell you the truth here. I have to eat a Twinkie today because we'll talk about that. And I think either Mrs. Icecap ate the last Twinkie, or maybe I ate it. I just didn't refresh it, but I don't have a Twinkie, but I have something else.
Oh man, this is a party foul.
I have a cake. Yeah, I have
Party
a
foul.
cake. It's a
okay, buddy. Starbucks, like primo.
it's a lemon loaf. It was like $8.50 or something. I think
That sounds awful.
I know.
Yeah, that doesn't count. We'll hold you to it next week.
Actually, I go to the same coffee shop all the time, and they always comp me all the patisseries. So I love it, of course. But Mrs. Icecap sees me getting like a little bit bigger.
How do you get that
week.
comp? Jesus, no, yeah. Inflation's definitely.
You just got some kid fired, by the way.
No, it's just called being nice to people. You chat with them all the time, and you get to know people. It's a beautiful world.
Does Mrs. Icecap know that you flirt with the barista at the local Starbucks?
Yeah, she's in on that one. Cut, rewind, edit. There we go.
But lots going on here. So we'll hold Keith to a proper Twinkie in the next episode here. I'm not accepting this lemon loaf garbage. Bank of Canada to start things off here, raising rates 50 basis points, right? So Rich and I had 50. The market was expecting 75, right? So the market was pricing in the expectations for 75. So it was definitely a little bit on the surprise. I mean, it's funny because like, I'm kind of curious your guys' thoughts, which is everyone was like, oh, maybe this is like the start of like the pivot. We're like near the end. This was like a dovish rate hike, only 50 basis points. It's like, I think like when you actually like zoom out in context, like 50 basis points is still like an oversized rate hike. Like 50 is not normal. I mean, it's still a big move. But yes, it was certainly below expectations. So I don't know. How are you? Do you guys, do you have any takeaway on that, Rich, Keith? Either you want to chime in there?
Yeah, sure. I'll go for it. I mean, I think we were very critical of central banks all the time. I think we may or may not have made our Loonie Hour career on it. But, I think it's important that they see the tea leaves, see what's going on. Obviously, the housing market is an important part of Canada's economy, right or wrong, like it or hate it. That's them's the fact. And I think it's also important to recognize what we talked about last week and a couple of weeks before that, which is some of the key inflation data that we're seeing has stopped rising. So something I've been very critical of the Bank of Canada is ignoring the preferred measures of core inflation based on factor model, GDP model, and the trimmed mean model. And those have rolled over. They've stopped rising. They've actually started to come off in a bit. And so the fact that they've slowed the pace, again, as you pointed out, Steve, correctly, 50 is still a significant number. It's outsized of the normal 25 basis point increase. So for them to, again, not slow down their rate, not cut, but to slow down their rate hikes, I think is appropriate given the data, given Keith's, ongoing accurate point about recessions, given my point about the slowing inflation. It seems okay that they're just slowing the pace of their rate hike. So God help me, I actually think it was the right call. I guess I'm getting soft in my traveling days. What can I say?
The YouTube comments will have a couple opinions for you, Keith.
Okay, so let's. I'm going to bring you guys back to reality. Okay, you guys are starting to move to that economic fantasy land. I know Rich is there full time and everything.
Like one of those PhD professors.
But there's a couple of things going. So by the way, guys, like this lemon loaf that I'm eating, it is nice, but I don't like the icing, the white icing.
That is the best
ribbon.
part, by the way.
I take it off. I don't like it. So I've
Why don't
now
you go back and
removed
take
that.
your free lemon loaf back? Why don't you ask for a refund?
yeah. That's I do like it. I got a couple of croissants as well. Sometimes they're nice, and I don't like the cake pops. They put like a little cake on a lollipop stick. I don't like those. But let's go back to the Bank of Canada here, guys. I disagree with both you guys. I think both you guys are Loonie Hour people now. That's crazy. So for starters, I don't know where to go here. So many different things. It literally was a shocker yesterday. And just remind everyone, central banks and the Fed is really good at it. They always guide commercial banks, whether the commercial bank is correctly positioning for a big change in overnight rates, because it affects how banks are positioned on so many parts of their book. So in the US, for example, because they can see how banks are positioned for things all the time. And if they discover one of the big, just say JP Morgan is off base with what's happened, like they'll say, hey, you're stretching out, you're a bit too far. So when I commented on the Bank of Canada doing 50 instead of 75 as being a shocker, it literally was. The whole street was saying, what the heck? Like you're guiding us to this position. They even came out with a video basically warning everyone that, hey, we're hitting for some hard times, but it's going to be worth it. We have to crush inflation and all that stuff going on. So, I'm enjoying my lemon loaf. And however, it wasn't the right move from what they did, because they told us they're doing something else. The next part about this, do you guys see what happened the day before out of Ottawa? Or 2 days before?
Something to do with the ArriveCan app?
No. Well,
Jagmeet. Jagmeet Singh.
Yeah, your buddy out there out west.
My good buddy Jagmeet.
Yeah.
What happened?
He sent a very sternly worded letter to his good friend. To our prime minister, telling them to tell the Bank of Canada they have to stop raising rates. Yeah.
Funny
Yeah.
that. I thought we were just over criticizing our double P about how the Bank of Canada should remain independent. And all of a sudden, this boy is interesting. Okay, keep going. Sorry.
Yeah. So, did the Bank of Canada bend the knee? I don't know. I doubt if they're bending the knee to the guys with the orange shirts. But by the time you get a letter from, leader of one of the big three parties as presented in the open, that just doesn't happen overnight. Like there's a long build up to that. So there's been a series of, phone calls, meetings, you name it. Like the pressure on the Bank of Canada to stop this path where they're going, it's incredibly strong. And it's irrelevant whether they agree or disagree with it. Central banks in the Western world, anyway, they're supposed to be independent, and they're supposed to act, independent based on political pressure. But both sides now up here in Canada, as well as with the Americans and even the Europeans as well, is down that path. But the bottom line here with the Bank of Canada, I think they gained a lot of credibility, and then they lost it all yesterday. I don't know how they recovered from it now. And I know
you're letting that icing sugar go to your head.
I didn't eat it.
I don't think they have credibility at all. I don't think they gained any credibility. They had none to lose.
Well, you gain credibility when you're transparent. You say, "Hey, we're going to do this," and then you do it. Because remember when they first started the hiking cycle? They're coming, and then they didn't do it. They said, "Well, I want to wait one more meeting," and everyone's like, "What the heck? You just told us you're going to hike." And then finally they got going, and all of a sudden they went boom, 100. They're like, "Geez, guys, like slow down. What's going on?" So I mean, they're flipping and flopping all over the all over the wharf there right now, and I do think it's creating a lot of chaos and confusion that's coming up here in the economy.
In Han Veer, we trust. I don't know if you guys know who that is, but that was we were talking about it last episode. So Han Veer is I think that's how you say his name. He's the guy that started the protests for homeowners against the Bank of Canada rate hikes. So there's a lot of Twitter memes going viral right now that Han Veer is a Canadian icon, a national hero. He prevented the Bank of Canada from raising rates 75 basis points with his homeowner protests. But yeah, I mean, I think just to put things into context, right? Like we're still up on the year, we're up 350 basis points year to date on rate hikes. Remember, I mean, it's funny, like, remember the beginning of the year, Scotia came out with like the aggressive rate call, and they had rates going up, as much as 200 basis points for the year. Right. So like the reality is like, we're probably going to finish like, up 400 basis points to finish the year, whatever. So like even Scotia missed it by, essentially double. So
to be fair to them, we were mocking them quite mercilessly. Yeah, we have some egg on our face on that one for sure. And I
have some icing sugar, the ribbon thing.
I think we already admitted our faults on that one. But I think like these markets, though, like, it's just funny, like, you go on the YouTube or the Twitter comments and everybody seems to have it figured out. But like these macro markets, which is what this podcast is all about, like is the volatility right now. If you haven't had a wrong call this year, like you're full of shit.
Great.
These markets are making fools out of a lot of people. So it is quite fascinating. Like I said, up 350 basis points year to date. Keith, what are the what's the old Bloom tubes there? What are they telling you for what's the now expected rate hike path for the Bank of Canada over the next sort of 6 months here? Like what's
first of all, they're telling me I need to pay my quarterly invoice, so that should be paid soon.
Dipping out of the Loonie Hour funds.
Yeah.
Also, Keith pays for the live prices, so it's an extra special premium there. I'm still 15 minutes behind everybody.
I can get live like hog prices in Chicago. So right now and again, you don't know where to do this anymore because the financial market instrument now, they're pricing that the Bank of Canada will peak at 4.25, and that will be achieved in Q1. So another 50 basis points. Now remember, 3 days ago it was at 4.5, and but that was my point though, because if you want to hedge any kind of like overnight interest rate exposure you use the Canadian Bankers Acceptance Contract, or the BACS that we call it. And, that it's a very powerful instrument for Canadian financial institutions as well as large institutional investors. And you're able to do different things with it. But that was priced in, 75 basis points yesterday. And I can never, just like that, Rich, that got tipped over yesterday. So anyway, right now it's saying, hey, another 50 basis points. And, do they do that, for the December 7th meeting? Do one more, like 50 and they're done, or
25 and done?
I mean, we don't. Right now they're suggesting it's going to be 225s.
Actually,
we'll see.
Some interesting commentary there. I don't know if I watched the press conference there. So of course he says, hey, like, we're not done yet. Don't consider this a pivot kind of thing. So he says, they still got a little bit of work to go, but they're definitely towards the end. I think what was interesting is they actually flagged financial stability concerns, which I found quite interesting, right? I mean, so they're obviously looking what's happening in various markets around the world, and citing financial stability as a concern. I think that's probably why they didn't go 7. They went 50 instead of 75.
That's a really good point, Steve. I didn't pick up on that until you just mentioned it, and because remember, they have access to information, everyone else doesn't. So maybe they are taken off it. By the way, I do interpret it as a pivot. Because the pivot in the investment world, it's versus expectations. And now, because remember, a pivot is not, no central bank is going to go from hiking rates to cutting rates. That doesn't happen. You continue your path and then you pause, whether it's up or down. And in the US, normally a pause is 8 months. That's what it is on average. Could be shorter or longer, of course. But I think, so now you have the Bank of Canada has pivoted. You've had the Aussies, they, pivot. Again, this is my definition of the pivot, guys. So, but, they raised hikes by less than what was expected. And we'll jump into the Europeans this morning. They came out and they basically did the same thing as well, which is then leading, we have the Americans coming out next week. Everyone's thinking, hey, maybe they're next. Maybe it's the long line of, the throne.
So I want to get your thoughts after that. I got a couple things I want to chime in, and Rich, I'll let you get in here in a sec. I want to circle back on your thoughts on the Canadian dollar, because people are saying, oh my God, the Canadian dollar is, going to get killed here. Like they pivoted too soon. Thanks a lot. You're going to bring in more inflation. So I want to get your thoughts on that in a sec, but Rich, feel free to chime in here.
Well, I was just going to say, isn't this also an indictment of the way that we understand market interest rate based expectations? So just so everyone understands, when we look at, so Keith's right, messaging is important. I'm never going to deny that. Keith makes a very good and often, and he repeats it like an old man should, talks about how when a central bank sets out a path, they need to stay on that path, and credibility comes from forward guidance and then meeting those expectations and then being clear about whether you're going up or down. But I also think what we forget, and I think it's important our listeners understand, is when we look at the bankers acceptance contract or the Fed funds rate or the forward overnight index swaps, which is another instrument, or whether it's in Europe, and I can't remember the name of that particular contract. These are market expectations. These are market-based expectations. They're priced. And so what does that mean for people who don't understand is it's just bets. It's bets as in the same way that it's bets on a particular stock. You think when you buy a Nike stock, you think that you think that you're going to have a greater fool. You think that in the future that you're going to be able to sell it for a different price. It is the future value of cash flows discounted to a particular price. And that's what you're willing to pay for it. And the aggregation of everyone's view on a particular instrument is the price that the market is willing to bear. That's the same is true for bankers' acceptance notes, for Fed funds rate, for forward overnight index swaps. And so on some, I just want to say, like, it's also yes, they kind of screwed with the market. They screwed with people's expectations, but it happens at the inflection points, because at the beginning of the rate hike cycle, nobody was expecting any type of rate hikes whatsoever, as Keith alluded to earlier. And those market expectations were wrong. And I just think, I can't believe I'm going to agree with Keith in the sense that it is a pivot, in the sense that you're wrong footing the market on the way up, which is one pivot. And now you're wrong footing the market on the way down. But it's also important to recognize that market expectations, market pricing of future events is often wrong. And so we can't, although it's important to look at them, and the chart that we'll share on our YouTube video will be of forward overnight index swaps. Sometimes people just get it wrong. The market gets it wrong because they don't anticipate and they don't accept the data as it comes. And I think that's also important we understand, or as listeners and as investors, we understand that the market's not always right about these things, and we have to be sort of accepting of those kind of changes. Keith doesn't like what I have to say.
Keith's pissed. Get in there, buddy.
Well, I just finished my lemon loaf. Now I'm able to talk again. Steve, how did anything change on your desk from yesterday's
that was my question.
Interest rate move?
On the housing front?
Yeah.
Not really. No. I mean, we actually managed to jam a bunch of deals through before the rate hike. So that was nice, because I think like that's what you're looking for, right? Is these deals that get tied up with subject conditions, and then you're like, oh, subject removals on the 27th of October, a day after the rate hike. Oh man, what could possibly go wrong? So yeah, definitely. I think anecdotally, we definitely heard of obviously deals collapsing and stuff. But yeah, I don't know if you guys want me to just quickly chime in on like some of the mortgage side of things.
Yeah, definitely. I'm curious.
So I think our buddy Hanveer there had a point, which is, I think these rate hikes are going to crush a lot of people, right or wrong. There's obviously a lot of people that are hoping for a quote unquote rebalancing in the housing market. But if you look at, let's say you had a $500,000 variable rate mortgage with a 30-year amortization. So I think if you put things into context, a $500,000 variable rate mortgage with your national house price in Canada, national house price is about $800,000. So, a $500K mortgage is very, very sensible, I would say, in reality in today's market. So in February of 2022, just before the rate hike started, your monthly payment on your variable mortgage would have been about $1,700. Your November 2022 payment will be $2,700. So if you took out a $500,000 variable rate mortgage, you floated it, after all of these rate hikes, your monthly payment has increased $1,000. So it's pretty big. Now you take that same math and you run it in some of these more expensive markets like Vancouver and Toronto, where, again, prices are well north of $1 million, that it's very, very common, I would say, for young families, people, professionals in their 40s, 50s to have $1 million mortgage. Very, very common. If you floated that, your payment would be up about $2,200 per month from the beginning of this year. So you would be looking at, on $1 million today, you're sitting at about $5,600 a month, and that would have been around 36 earlier this year. So again, huge moves, and I think this is why central banks say, hey, it takes about a year on average for interest rate increases to filter through the real economy, because what happens, right? It's like, okay, your monthly payment's up $1,000, $2,000 a month. You start scraping everything you can together to pay that monthly mortgage, and you just start cutting everywhere else. And it takes time for that to like filter through into other businesses and the real economy.
Can I ask you a quick question? So if let's say right now they stopped, so the main policy rate is the overnight target rate, whatever you call it, is 3.75. If they stopped right now, do you still think there would be significant negatives to the housing market in aggregate in Toronto and Vancouver? Like, do you think we still have, if they stopped right now, do you still think we'd feel a lot of pain going forward?
Yes. For sure. Yeah, the rates are too high. It is. People are getting all upset. Oh, mortgage rates at 5% are not too high. It's like, okay, fine, but like the asset has been priced at mortgage rates of 1.5% to 2.5%, and now you're at you've doubled that. So it's going to take time to adjust. I see that more being like, if you were to say, and this is me taking an educated guess, if rates just stopped here, I think the housing market it would just be very sluggish for probably the next 18 to 24 months. Prices would slowly adjust. I think you'd have a lot of the issues that are underlying that would continue to build, which is people on these 1-year bullet loans through private lenders, through alternative lenders that have to go and renew your 5-year typical mortgage, right? Like your typical mortgage about 5 years ago that's renewing, you would have taken out a 5-year fixed about 5 years ago, you would have been around 3%. So you would be renewing today at 5.5%. Like that's a big jump in your payment, right? So like I just think like we would have probably very slow growth, weak housing, I think, with rates if they just stopped where they are. To that point, I'm just going to quickly touch on this and then we'll switch gears here. But I wanted to point out a couple of interesting things because people say, oh, the housing market, it is what it is. So this is from my good buddy, Ben Rabideau. In the greater Toronto area, a metro region of nearly 6 million people, there were a total of 45 new single family homes sold by developers last month. So it's
45 homes in
45.
1 month for that.
In one of the largest metropolitan areas in all of North America.
Toronto, yeah. So Toronto new single family home sales dropped 96% year over year in September. New condo sales down 89% year over year. And this is from data is from Build and Altus Group, which are two very, very respected firms in the industry. Altus Group's actually publicly traded. So the data is pretty good. It's accurate data. So that's your largest metro housing market in Canada. New construction is getting absolutely pummeled. And actually some good data here from Zonda, which is another massive data collection source for new homes in Vancouver. So in the third quarter, Q3 of 2022 in Greater Vancouver, there were 1,522 pre-sale condo and townhome transactions. That was down 72% from the same period last year. So the reality is that the damage that has been done from these rate hikes is still don't think is actually filtered through to the real economy. Projects are being canceled, prices are being decreased. People will begin to get laid off in the construction industry. It's starting to happen. Hopefully that brings down some of the costs. But yeah, I think that the concerns, I know people get all upset about it, but I think people are maybe a little bit naive to the implications of. I think there's going to be some damaging effects that are going to be with us for a couple of years.
Some folks might get hurt.
Yeah,
Of
which
course.
again, part of the cycle. Cycle.
By the way, when I say folks, I'm referencing someone who's used that term all the time. But let's just stay on this same track here for the Canadian economy. So now we know that not everyone, but some mortgage owners have higher payments coming up because most people were at fixed rates and stuff like that. And Steve, you did mention that layoffs are happening in the construction world. I'm not close to that world. I don't see it myself, but is it happening? I'm not seeing job losses where I am yet. Are you seeing anything where you are?
So here's what happens. The big boys, they just pause. So you got a lot of these big developers that have been around for 40, 50 years. They just hit pause. They go, you know what? I was going to launch pre-sales of this 50-story high-rise concrete condo building. And, I don't like the market. I think it stinks. And I don't want to sell into this market. I don't even want to, it's not worth the headache, the stress. And, so they just pause. And these guys will sit on that piece of dirt for 4, 5, 6, 8 years. And they'll wait for the market to come back. Now you get these other smaller to mid-sized guys that don't have quite the financial depth, and they'll have to try to push through, and
Or
I
go
think
out of
that's
business.
yeah, they'll end up going out of business. Because they have to push through. A lot of them are relying on private money. They've raised capital from, more retail investors, stuff of that ilk, where they can't sit on dirt for 5 years. So they are forced to push through, and those, I think, are the ones that ultimately will probably, some of them will end up into receivership. They won't make it. But the reality is like, even like when the big boys start hitting pause, right? Like, that's just contractors and tradespeople that aren't keeping occupied with new work.
So it hasn't then yet spread anywhere else in the economy, correct? That's my interpretation.
Yeah, I mean, I suppose I'd say that. I think like we're certainly going to see. I mean, maybe you guys know better than I do, but let's watch Canadian retail sales, right? Like, I think.
No, I say that because I know what I mean. We're riches now. Like, no one ever works. Everyone's always at the cafe. But over here in the real world, where we have economics all the time, because one of the interesting takeaways. I love Rich, by the way.
You're such a prick.
Boy. No. But one of the takeaways from the Bank of Canada presser was that they are now they're now stating that they are expecting what were the words they used? A mild recession coming up. So remember, before there was no recession was coming, then it's like, hey, maybe it might happen, and then some of the big banks said, yeah, we're now going to have a recession. It's going to be a soft landing. Finally, the last guys to admit it is now the Bank of Canada, and so the concern that we should have is that once that happens, so everyone now all of a sudden they have to pay an extra $1,000, $2,000 a month, whatever, on those that were affected by rising rates for their mortgages. If suddenly now the economy does decline, and say people trying to carry those mortgages, they don't get a bonus or a smaller bonus and so forth, that it has the opportunity to roll over into what I expect will be a hard landing. That's where we are. So now, with the Bank of Canada, unofficially pivoting, of course, that means next month they'll hike by 75 again, right? Just to screw around with the Loonie Hour. But
sounds like sour grapes there.
I like the lemon loaf. But I think though that's where we are now. Like they're obviously they're now able to see themselves that we could trip up here. That's where the potential is. And of course, I think this ties over with Europe, which we'll have to go into next, because the ECB were out this morning as well. But Rich, did you have another comment on the Canadian economy?
On the last thing on the Canadian thing. I mean, every week, hopefully we're gaining newer listeners, people who haven't heard us before. So forgive me if I'm repeating something we've talked about before. But, a year ago, I shared a chart that I thought was really important, which is residential investment as a share of GDP. So in my world, in the nerd world, you have gross fixed capital formation. So how much of your GDP you're allocating to building capital projects, so CapEx, and you can do operational CapEx, you can do non-residential CapEx, think of equipment or manufacturing, and you can do residential CapEx, which is residential where people live. And then we at the time when our dear leader Tiff Macklin was telling everybody to go and borrow, residential CapEx as a percentage of GDP was already extremely high. And the warning that we made on this podcast, whether it was on Twitter or whether, frankly, it was in private discussions, was, listen, whenever you get to these certain levels, it is basically virtually impossible, not impossible, but virtually impossible to unwind that kind of overinvestment without pain. And not to say I told you so, but my goodness, I told you so. Like, you just cannot do it. So just to remember, Canada's residential CapEx as a share of GDP peaked at like a 10.5% of GDP. And to remind everybody, Ireland, Spain, the US, they peaked out at 12, 11 and a half, and 7 in respectively. And I think that this is just the reality that I think Canadians need to come to terms with. And it's a shitty message to give on what should be a fun and an entertaining and informative podcast. But the reality is when you're spending that kind of when you're spending that much of your productive capacity on what is ultimately, sorry, Steve, I always say this, a non-productive asset, when you have the unwind, when you have that number start to fall, as it did in the US, as it did in Ireland, as it did in Spain, it's almost impossible to hide from those negative effects. And that's why Tiff Macklin, frankly, should bow out gracefully. But it, deserves a lot of, let's say, if you don't have anything nice to say to somebody, you shouldn't say it. I'm just saying this is why it's very, very hard as we go forward. If that unwind is going to be very painful for people, and it's tough to admit, it's tough to talk about, because there's a real people and real lives on the line, real jobs on the line, real savings on the line. But there's virtually no way that Canada can escape the laws of gravity, and no other country did. I don't think Canada can, even though it has an incredible population growth. And it's something that we should all sort of, whether it's you, me, Steve, or whatever, we should all sort of be quite cognizant of. And sorry, that's my last piece on the Canadian. We can move to Europe.
No, no, it's a good way to. I got one last question here. Maybe this is for Keith, but because I had a lot of commentary on this on Twitter, and just reading the overall sentiment in the room. There was a lot of discussion post rate hike. Okay, 50 basis points. These guys are not serious about fighting inflation. Oh my God, rates are still too low. I personally disagree, just because I'm looking at the housing data and saying this is a train wreck. But the discussion was the Canadian dollar is going to weaken. We're not being viewed as inflation fighters. The Canadian dollar is going to weaken. We're going to import more inflation. This is going to be, the 1980s all over again. And so, Keith, I'd kind of like your input on that, because I guess my perspective, and I'm certainly no expert, but my perspective was, yes, everything's going to weaken against the US dollar, but if every other central bank sort of slowly pivots dovish, it nets out. I just don't think Canadians are the only one here that are doing like a soft pivot here with 50 basis points. We already talked about the RBA in Australia there, and I'm sure you've got some comments on the ECB and whatnot. So Keith, I'm kind of curious your personal thoughts.
Yes, I mean, you always, when you're looking at currency, you always have to reference it to the US, right? It's the US dollar. So instead of doing Europe next, let's move over back towards the Americans. So the Fed is up next week, November the 2nd. I assume that's a Wednesday. That's when they always come out. So right now the market's expecting 75 basis points from these guys. And, that's what they should do. However, if they do this soft pivot, and I do not believe that's what's going to happen, by the way. If they do, it's wow. But if they do, so they say they only do 50, or they do 75 and say, hey, by the way, we're done. And again, I think there's an extremely low chance they do that. You're going to see the Canadian dollar and euro and yen and all this stuff. It could go up 3% on Wednesday afternoon. I think equity markets will be up 6-7%. Like, it would be one of the.
I agree. Sorry, I agree.
It'd be one of the biggest like risk on rallies that we'll ever see. And at the same time, if they just come out and they stay on the path to say, hey, this is where we're going, then it comes down, and this helps answer the Canadian dollar question. If the Fed maintains we're doing 75, and Powell, he continues to say everything that he's been very consistent with since the Jackson Hole meetings they had. Now, on a relative basis, the rate differential is going to rise even further. So that creates just an opportunity for Canadian dollar to come down. Absent a crisis or a really stressed Canadian economy because of housing. Again, I think, I suggested last week, we get a 2-year period with minus 1% growth for 2 years, it'll be pretty bad. However, if everyone is in that bed, we'll struggle through it. But if it's just something like that, then Canadian dollar will do okay, relative to other countries and economies. So Steve can head back to Europe and finish that, the Summer of Love tour he was doing. But we go back and let's stick with the U.S. right now. Unless, did you have another comment on that, Steve or Rich?
No, I think, that pretty much answers the question.
So some of the guys that I know, they share that they have contacts, with Treasury and the Fed and so forth. And the storyline is a pretty big tug of war going on right now between Treasury and the Fed, as well as, with inside the Fed as well. So, last week, was sort of leaked that, the Fed is going to pivot and turn dovish and stuff like that. And what I'm hearing, like Powell was totally ticked off with this. And he's pretty upset these days. He doesn't want to be the guy in charge of the Fed when they couldn't control inflation. He wants to be known as, hey, I broke the back of inflation, and years from now, we're all talking about him, with the same high, regards in this team, as we talked about Volcker, and I'm sure if we go back in real time when he was around, I'm sure it wasn't as nice and pretty as people think it was, 40, 50 years later. However, there's a risk here in the currency world that Powell comes out with, guns a-blazing. And then, so instead of having this, Wednesday afternoon coming up where, Canadian dollar goes up strongly, and then equities go up strong, stuff like that. It could be the opposite effect. So I think next week is going to be a pretty big week for financial markets, especially Wednesday afternoon when the Fed comes out.
What else are you looking at? I think you were watching ECB was out today. So they're still calling for more rate hikes and whatnot. What are you looking at there?
So just again with the U.S., the U.S. had Q3 GDP came out this morning, and the headline number was stronger than the estimate, but the underlying sort of inflation focused data was weaker. So you push it all together, it was a bit of a wash, and but the U.S. economy has suddenly come out of that technical recession they're in for the previous 2 quarters, and we'll see now where we start going to Q4. That's the last thing with the Americans you need to worry about. The Europeans came out this morning, so they hiked rates with 75 basis points. It was in line with what the market was expecting. And so what was really great though at the ECB meeting, in the presser, the questions were outstanding. I think it was the first 4 or 5 reporters. They were like, wow, bang, 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 bang. And, Lagarde was like, boom, boom, boom. She said, oh, let's slow down here, right? They were exceptional this time. So if you want to go back and watch the recording of it, maybe they've taken it down already, but it was a really good meeting today. But the lesson we got from the ECB this morning, and they also did a bit of this soft pivot, because they changed the wording slightly in their statement. And so the exact words, I don't have them here in front of me, but effectively before they're saying, we'll keep raising rates forever because we're going to beat inflation. Now we're not going to raise them forever, but we're going to raise them a little bit more because we're starting to win, which I thought was quite funny because they're thinking right now, after 2 months of raising rates, they've been able to calm and tame inflation. And whereas all the other central banks are saying it takes about 18 months for your rate hikes to have an effect. Rich, another comment there before I continue?
Well, I was just going to say, as usual, the ECB takes credit for shit they have no control over. I mean, the reality is I'm sure they're only watching the natural gas prices. So for people who may or may not know, natural gas is abundant beyond virtually anything that our wildest dreams. The only reason it's expensive is because of stupid energy policy from Germany and the rest of those idiots who follow Greta. And natural gas prices in Europe, in the UK, in the Netherlands, so the ICE, the tidal transfer facility, which is in the Netherlands, if I'm not mistaken, and the trading hub, which is in Europe, are down now to $50 per megawatt hour. All it's to say is they've collapsed. And so, I mean, I'm giving Keith too much credit this week, but I mean, they're basically probably just watching the natural gas price going, oh, we've done our job. Natural gas prices have collapsed, so we no longer need to worry about inflation. Remember, natural gas is a key input to the German industrial base. The German industrial base is suffering 50-60% of increase in producer prices year on year. If you collapse the natural gas price, for whatever reason, you affect the producer price index, and the producer price index flows into the consumer price index. And so I don't know, maybe I'm learning from you, Keith. I'm being more cynical as I get a little older. I'm watching the ECB get dovish all of a sudden, pivot, whatever you want to call it. And I just see it as a direct function of this natural gas price come down. Nothing has changed in Russia. Nothing has changed in Ukraine. But the natural gas prices has collapsed. And that is a key input to the European growth project, the European environmental project, the European everything project. And so maybe, call me cynical. My goodness, am I learning something? Maybe I am, but
yeah. However, I think you'd want to be known as a skeptic instead of a cynic. I don't know if they teach you the difference in
I'm not sure schools. I know the difference, to be honest.
Yeah. Well, just stick with the ECB and what jump. So very quickly though, everyone's talking about, the winter from hell that's coming for the Europeans, but their nat gas storage is now at peak levels almost everywhere. So because I know we mentioned that a few weeks ago. We said, if they do have a mild winter, they'll get through it. They should be able to do it. So I think nat gas prices in some of the markets actually went negative at one point a few days ago over in Europe.
I think that's a great point, though. So just to chime in quickly, like, I'm not going to pretend to be a natural gas expert here, but my God, the sentiment on that like trade and view was just so lopsided. Like, I just feel like anytime like sentiment gets to like those extremes, like typically the opposite will happen.
Absolutely. That's something called technicals. We'll often we've talked about RSI, relative strength indicators. We've talked about the problem with being super negative. The equity market is when everyone is super negative on sentiment, on positioning, on technicals. You can be negative all you want, but there's only a certain amount of selling, Steve, which is exactly what you're saying. I think it's very important that people are very skeptical, is it, of those sentiment, and I think you're absolutely right.
Oh, no, such a skeptic.
Yeah, like I said, I think you can just apply that to really anything. I think it's just like a lesson learned for any market participant. I mean, we've certainly had some eaten some humble pie this year, some of our calls and whatnot. Never gonna get everything right, but yeah, I just like, my buddy Jared Dillian there always calls it. He says there's too many a-holes in the trade, right? Like, and everyone's lopsided natural gas, or everyone was on the uranium trade earlier, and it's just like it always tends to go. And then we had Bitcoin at what Q3 of last year, when everyone and their grandma's long Bitcoin. It's like it always tends to be like that sentiment indicator top.
But similarly, now everybody's convinced it's over.
Yeah.
Go ahead. Sorry, Keith.
I bought Bitcoin at 66,000.
No, you didn't. You don't even know how to buy it.
But now that everybody's convinced Bitcoin is over, you get Rishi Sunak, who's now he's the cheerleader number one of central bank digital currencies, which, God help me, will be the end of the liberal democracies as we know it. He's a cheerleader. Everybody's convinced Bitcoin's over, and lo and behold, it is just middling around 19,000. Similarly, everyone was convinced that natural gas was going to go to the moon. Lo and behold, just so everybody understands, there's plenty of natural gas in the world. There's absolutely no reason it should be whatever it was at, it's something like $200 US per megawatt hour. That's ridiculous. We understand where it is. We understand how to get it.
And that's for Europe, by the way. So everyone's not.
Excuse me. Sorry. Yeah. Sorry. Excuse me. That's right.
No. So I mean, the one argument that you tend to see quite popularly online, and again, we'll see. I mean, I don't have a strong opinion on this because, like I said, I'm not going to pretend to be an energy expert.
No, neither am I. But
everyone is like, they think inflation's coming down, it's decelerating, but just wait until Europe, winter in Europe and the oil shortages, and so I just feel like that mindset or that view is very, very overplayed. But
Steve, you might be right in the sense that Europe may be squeezed let's say winter is horrible, it's very cold, there's a significant need for natural gas. That doesn't change the fact that there is an incredible amount of this particular natural resource. And if traders like Cargill or a bunch of other monkeys who live in Switzerland who trade these commodities professionally understand where they can get this arbitrage opportunity, they will move heaven and earth to exploit that. It will bring down the price, they will collect their bonus, and the world move on. And that is frankly the beauty of capitalism. You supply will meet demand wherever it can, And this is people don't understand, like something that people just don't understand. Commodities like fossil fuels should not be expensive relative to GDP, relative to humans' disposable income. What is making these commodities expensive is stupid green energy policy. That's the answer. We've talked about this for 6 months, so I will spare you guys, but we've talked about this almost for 6 or 9 months. We've talked about this. This is an acute stupidity factor that is affecting the price of these commodities, and hopefully we're seeing the end of it. I know I get excited about the green energy
just
policy.
before the YouTube comments.
Please don't beat me up, Keith.
Yeah, just before the YouTube comments rip us apart. When we say Europe might get by this winter, we don't mean they're going to prosper. I mean, they're going to get by. And so, yeah.
Muddling is not thriving.
Yes. The rhetoric was that people were going to be shivering and dying of starvation on the streets. And, I think it's probably not that bad.
Well, a couple things. I'm just trying to unpack everything Rich said.
Oh, come on. You agree with me. Don't be shy.
I know, but just to paraphrase, seriously, what Rich just said was that, capitalism, it's price discovery. That's the way the world works. And it works everywhere in the world except for one place, and that's the economic fantasy land called Europe. So let's not confuse the little swing and enthusiasm coming from the two young fellas here. My long-term target for euro is still 0. I think it goes to 0. That's where it's headed. So one more comment from the ECB this morning, which is, again, it's just outstanding. So, again, we like to talk about everything, risk around the world has been synchronized, so that the Japanese, they're in trouble. Canadians are in trouble. The Brits are in trouble. And then you have the Europeans, of course. But the main challenge that the Europeans have is that they're raising interest rates to bring down inflation. And they're also trying to do QE to protect their bond market on the long end, which is really Italy. But they're raising rates aggressively. They've gone from 0 to 200 basis points very quickly. At the same time today, they softly admitted it. You could barely, you got to read it to find it, and they don't even assign a number to it. Like, that's how critical, that's how important it is. But basically, they shared with us that economic activity likely slowed significantly in Q3. It's going to slow again in Q4 and again in Q1. So we're looking at 9 months, maybe 7, maybe 12, of where now the ECB is openly admitting, we're headed for a pretty good downturn coming up. And again, I don't know how we reconcile that. I think it will help with the whole inflation story, but I know we're talking about sentiment, market swinging, this way and that way and whatnot. But guys, whereas if we have a recession of some sort, we run into trouble here in Canada, we do have that energy production component. All of a sudden, Alberta and Newfoundland is everyone's best friend here in Canada. I don't know what Europe has. I really don't. But what they don't have is a consolidated federal debt market. And I think they are headed for some trouble there, especially for the Italians coming up. So if you have a chance, go through watch the video for the ECB presser today, which was really great. And to make it better, go to their notes that they put on their website, and you can't even see any numbers. If they have, say it's a 2,000 page essay, I mean, this is a central bank. It's a number world. Rich, you would be shocked at how many numbers you see in this essay that they put out there. You ready for it? It's fiction. That's what it is.
Well, I mean, one thing that Europe does have is a cratering currency. And for an economy that is so dependent on exports, remember before this energy fiasco, Europe's current account balance was about 3% of GDP, which is quite strong. A country like Germany, who's dependent on exports, was 6 or 7%. Even Italy, who has in the past been quite the basket case, had a strong current account balance for the first time in a generation. Same with Spain, in the first time in a generation. We know the smaller countries like Portugal and the rest, they survive on exports, right? And so one thing that I've noticed on my side when I look at the key missing ingredient to being really positive risk assets, which is earnings. So earnings track GDP growth or economic growth, and earnings expectations can often be swayed significantly by currency. So you have to think about global analysts. There's thousands of them. They're all sort of trying to figure out what individual companies there are. Let's say 10 or 15,000 publicly traded companies in the world. Let's say roughly 50% of them are in the US, another 10% or whatever, 10% in Japan, 20% in Europe. And you're seeing the global earnings revisions ratios. So the analyst expectations of earnings going up versus the earnings going down in Europe stay positive. And that's a function of the fact that they are, as a function of the fact that the euro continues to crater. So last week you mentioned, Keith, that the export data from Japan was actually really okay. And if you look at the sentiment data from the business sentiment data from Japan, it's actually starting to improve. It's not a surprise, right? They are an export economy. They have a currency that's depreciated by 40%. If you can get your widget from Japan versus China, you'll do it. If you can get your widget from Europe versus China, you'll do it. And so one thing I find really fascinating is, in fact, that the earnings revisions ratios out of Europe continue to stay positive. In fact, are rising, which is shocking. I know Keith hates Europe, but there are strong companies, and whereas in the US it's the opposite. You've got companies that are valued in USD that are selling products in foreign currency. So if you think of Apple, you've got, let's say, I'm making this number up, but let's say 50% or 40% of the revenue comes from outside of the United States. Well, if your currency has gone up by 20%, it means your foreign currency sales, forgive the numbers, have gone down, let's say, by 20%. And so you're seeing a significant derating in these earnings revisions in the US, in China, because it's pegged to the US dollar. And I think that that's just like something we haven't really talked about, which is the earnings quotient. And maybe we'll talk about that next week. But that's the bit I'm waiting for as far as being positive risk assets. But the market doesn't care, right? The market's up. It's bounced off the 200-week moving average. We didn't talk about this week. Maybe we'll talk about it next week. But those technicals are really fascinating.
Yeah, I think it's a good place to wrap it up. We spent so much time making fun of Tiff Macklem that we didn't get to a lot of interesting stuff. Obviously lots happening in China, China-US relationships in particular.
Oh yeah, we forgot about China.
So maybe we'll touch on that next week. But huge events happening over there. Obviously we've got the Fed coming out with their rate hike announcement next week, so we'll have some coverage on that for the Loonie Hours episode next week. Just and obviously recap of US GDP as well. So, but yeah, we want to thank everyone. The Loonie Hour event in Toronto, December 1st at the Hockey Hall of Fame, officially sold out. We did it in less than a week, which was fantastic. We really appreciate your support. I think it took us like 3 weeks to sell Vancouver or something, our first event, which turned out to be a really good time. But to do Toronto in less than a week when none of us live or are from there is definitely very humbling. So we really appreciate the support. And that's pretty much it. So I mean, there's been people that have asked us about, waiting lists, if tickets come available. Just email us if somebody does eventually reach out and say, hey, listen, we can't make the event, can you refund our tickets? We're happy to issue a refund and give your ticket up to somebody on the wait list. So other than that, as always, appreciate your support. All we ask that you share this episode with at least one family or friend member. Help us continue to build the Loonie Hour community, and we'll see you next week.